Well, as you know by now, ESG is a hot buzzword, environmental, social, and governance, some new lenses through which many big investors are looking at their investments. And one large investor is actually divesting of several companies that it says are not up to snuff on those standards. That is Legal & General Investment Management, which has a total of about $1.3 trillion under management and stewardship globally. John Hoeppner is head of U.S. Stewardship and Sustainable Investments at LGIM America, and he is joining us now. Now, the four companies that you guys announced that you were divesting from, pretty diverse group here: AIG, Industrial and Commercial Bank of China, PPL, the Energy Corporation, and China Mengniu Dairy. And I know the concerns were different at the different companies, but sort of high level, what are you asking your invested companies to do right now?
Sure, thanks so much. So we have set a very transparent climate assessment, which ultimately is based on net zero commitment, but is industry specific. So for each industry, we have very clear metrics that we look at companies on a comparable basis and say, are you meeting our minimum standards? So for example, in the finance industry, we want to see disclosure of Scope 3 emissions related to your investments, and we want to see a specific policy related to coal. In the case of the Industrial and Commercial Bank of China, that wasn't available. For utilities, we want to see a very specific phase-out plan for coal generation. For PPL, that didn't have it. And again, I guess in food, we want to see a deforestation policy. And so for the dairy company, we didn't have that. That they didn't announce that yet. So they didn't meet our minimum threshold. Sure.
And John, you reinstated Kroger. Why is that?
Sure. Kroger made tremendous progress. So last year, as part of our annual assessment, we announced that they were under our minimum standards. And we specifically cited, again, a deforestation policy, transparency related to their supply chain, and they stepped up. We saw a step change over the 18 months where we had continuous assessment. They made progress. And then we have reinstated them, which then means, that means that they're now part of our full portfolio.
John, I'm curious, we've had sort of an ongoing discussion amongst ourselves as of late as to the value of purchasing carbon credits versus actually switching your energy sources to renewables. And I'm wondering how you guys weight that, one versus the other.
Sure. We don't see it as an either or, but our, let's say, house view is that purchasing carbon credits as a means to offset your total emissions is a poor strategy, right? Maybe that complements some of your internal efforts to make changes, but our headline position is that is not a corporate strategy because it's not solving the system level risk, which is, too much carbon in the atmosphere. So, you could imagine a world where everyone's buying carbon credits, but it's not actually decreasing total carbon emissions. So, our house view is that could be part of a broad portfolio approach, but that as a standalone strategy to how you're going to meet your, net zero goals is not sufficient.
John, I'm curious, industry-wide, how it seems to you this conversation has changed. When you're approaching or reaching out to management teams on, we're expecting this, that, the other, how much more receptive are they to that kind of messaging today versus even just 3 or 4 years ago? Because it seems like this tide is turning quite quickly, and you have a new generation of executives who are very responsive to these sorts of asks.
Sure. The drumbeat has been growing, absolutely, in terms of corporates being receptive. But I do believe that the Exxon vote this year was a watershed moment. This is a moment where the investment community said, we're willing to listen to perhaps aggressive ESG tactics, changing of a board. And so that caught the attention of every corporate board in America, perhaps the world, that investors are willing to step up. Mainstream investors are willing to step up on ESG risk. So I have already noticed a change, but I expect the change is going to get a lot faster going forward.
And what do you think are the biggest changes that most companies need to make? Is it on the transparency front? Is it on the energy sourcing front, what do you think is still the biggest sort of tension? I mean, obviously, there's a lot of progress to be made on a lot of different fronts, but to you, what is most urgent and most important right now?
Sure. Transparency was the baby step. That is just that's the enabler for the rest, for the real action. So the real action, for sure, energy transition is going to be a major one, but it's not just energy transition. There are different social issues, pay or, diversity. I mean, the amount of pressure coming from all different actions is immense. So I don't think it's just as simple as, hey, it's going to be all about carbon over the next 3 years. It's this new mechanism, how we exchange, how society is creating value and how companies are interplaying with that is changing.
Yeah, it's almost an intersectionality of these different priorities for companies now that they have to consider. John, thank you so much for spending some time with us this morning. John Hoeppner is head of U.S. Stewardship and Sustainable Investments at Legal and General Investment Management America. And I should mention, I said $1.3 trillion under management. I think it's closer to 1.8. Thank you so much, John. Appreciate it.